Hey, it's Ryan from the Dividend Investors Club, and this is the Market Trend Tracker, where I help you track the trends that will make you a better dividend investor. And today we're going to focus on mining for value stocks. And I've got 4 sectors that I think you should focus on. Obviously, we've had a big run up since the big sell-off, and it's kind of hard to find those value stocks. It was very plentiful a few weeks ago, but now after the big run, the question is, where do you focus on now with new money? And I'm going to give you 4 sectors to take a look at. So here's our market trend tracker, and obviously on the left, it's the kind of big charts that we focus on. Just as far as market trend and what's going on with volatility, etc. And then on the right, we've got ETF sector performance. We love tracking the sectors with this heat map, and then the asset classes just below that. These all give us a sense of what's moving, what's driving the market, and kind of where to focus. So let me start up on the top left here. Like we do every week, and the past few weeks, ever since the big sell-off, I've kind of felt, as we tested this intraday low, down here, the 200-day moving average, I've kind of said I think the range has been set, and I think we're just going to continue to bounce along, in this range. I didn't think we'd come up so far so fast, but you can kind of just see in the last few days. Any big run up now that's getting closer to that, making a new high has been met with, big sell-offs. And so I do think we're just going to continue to bounce around down here. Very, very possible to test the highs, very possible to test the lows. So that's kind of how you have to adjust your mindset right now and kind of focus on what drives the market higher when it goes higher and what drives the market lower when it goes lower, and where is the value, and we're going to take a look at that today. But I think just generally speaking, I think we're right kind of in the middle of that range of where we're going to probably play out the next 3 to 6 months before we get a new catalyst to move higher. And I think the big catalyst that people are talking about is this next chart down here is these rising interest rates. And you can see that right now the spread between the 10-year Treasury and the S&P 500 dividend yield is over 1% now, and that's because the interest rates continue to rise. Everyone's expecting 4 rate hikes this year, and Chairman Powell just had his first testimony this week, and he sounded kind of hawkish, which is kind of spooking people out a little bit, and that's why the market sold off pretty big yesterday. And so that's going to be the focus, and that's really what's been driving the sector and asset class performance. And I'll show you. I mean, that's really been the big driver recently. So I think until we can get some more information that hey, inflation's going to be low, so there's not a need to continue to raise rates at the pace they're expecting to right now. That's going to be probably the catalyst that could send us higher. But I think we're going to need to see that first. And in the meantime, I think that fear is going to be out there, and there's definitely sectors that have been driven down because of that. And I think as soon as those fears alleviate a little bit, and I think it's going to be driven by inflation, that is where the value is going to be, and those are the sectors you're going to want to be in, because they're going to be a coiled spring at that point, and are certainly going to be the ones that are going to be bouncing higher at some point. So that's where we're going to focus, but obviously, just keep an eye on volatility. Volatility's come down below 20. You can see it's bouncing back around there a little bit. Don't be shocked if this thing comes back up and starts getting back above 20. And I don't think it'll test that high that we had from that flash crash, if you will, if that's what you want to call it, or the algorithmic crash we kind of had. But that sent the VIX over 50. We're down to a reasonable level now. We were way too low before, and so this kind of 15 to 20 range I think is a healthy level. It's actually going to give us a lot of good opportunities, I think, to invest and find decent value stocks over time. But keep your eye on that. If it spikes way above, obviously we're going to have some more volatility to come. But it's trading in a healthy level right now. But let's take a look at just year to date, what has been driving the market higher, and it's cyclicals, right? That's the name of the game. Cyclicals led the market higher. It led the market lower during the sell-off, and it's been leading the market higher again, just in the last few weeks. And so the lagging sectors, though, are the ones that I think have the most value right now, and those are the ones we should focus on. But it's not a back up the truck scenario right now. This is where you want to stick to the market leaders, but you want to focus on these because there is some really good value there. But a lot of these sectors have been hit significantly because of these interest rate fears, right? And so I'm talking about staples. Energy and MLPs have been moving more so from oil prices, but that's another value sector, and obviously real estate, telecom, and utilities, right? So if you just look at this, just year to date, and you can see just kind of the red and orange and where we're at, right? It's what we just talked about. Consumer staples, these are all down 5-6% this year, year to date. When you can see there's some sectors that are up huge, right? Financials are up 5%. Technology is up 7% year to date, right? 6% on the consumer discretionary side. So there's been a huge divergence in the sectors that are performing well and the sectors that aren't. I'm a big proponent of you should have exposure to all sectors. I think sector diversification is one of the most important things you can do as a dividend investor. But as you're putting new money to work, focusing on some of those sectors that are undervalued or underperforming at the time, and understanding why they're undervalued or underperforming is obviously the key. And I don't think the downside is necessarily the bottom's not necessarily in right now, but I think it's okay to start dabbling in some of those sectors because there's significant value there. And I think we're going to look 12 months down the road and say, wow, I should have bought a lot more of those stocks when they're down, right? When the blood's in the water right now, and the blood is in the water in these sectors right now, right? And so, real estate's just been taking it on the chin completely, utilities. And so these are those higher yielding sectors that tend to, clearly underperform because they're lower growth sectors. And, when interest rates rise and the 10-year treasury becomes more comparable to that dividend yield you're getting, people want growth at that point. They don't necessarily just want the dividend that's comparable to, a risk-free rate. And so that's why they're taking it on the chin. But, I do think that those fears are going to alleviate at some point, and those are the sectors that may be, leading going forward. But you can see it in the asset class performance too, right? If we scroll down, and that's why I think it's important to look at all this stuff. Dividend stocks are actually down on the year, believe it or not. With all the rise we've had in the Dow, I mean, it's the growth and this divergence here between value and growth has just so significant year to date. Right here, you can see right here's what I'm talking about. So growth is up 6%, value is actually down on the year, right? So there's been a huge divergence between value and growth stocks, and again, cyclical, non-cyclical, that tends to, the non-cyclical stocks tend to be more the value stocks, more defensive names, and the growth stocks tend to be more the cyclical names. So you can kind of see, it all makes sense whenever you can kind of see, what's performing and what's not right now, but huge divergence in value and growth. So definitely keep your eye on that. And this is another area that, again, dividend stocks have been hit because a lot of these big dividend yielding names and sectors, right? Real estate, utilities, energy, MLPs, consumer staples. I mean, this is the bulk of what a long-term investor looks for on the dividend side. And so those stocks have been clearly underperforming this year. We're down 1% on the dividend sector, and it's again value and technology, or I'm sorry, growth and technology that's leading. I mean, look at the NASDAQ here. The NASDAQ's up 8% year to date. I mean, that's incredible considering the run that we've had just recently, and so that's the things we're focused on. But I think looking at the second page is always helpful here. That's where I lay out all the sectors, and I've kind of got the stoplight thing going on where green is an uptrend. Yellow is kind of an intermediate trend, and then red is the downtrend, right? And so the sectors that are in downtrends right now are the ones that I think from a value perspective, that's where you want to mine for your value stocks. That's where you want to get your list of stocks in those sectors, and start nibbling on some of those things. Start looking at those market leaders. I mean, these yields are getting even better, right, because of the sell-off. And so what it's doing is it's making these stocks more attractive. So, if we if we end up, peaking on the 10-year at, 3.5 or something like that, in the near term, and a lot of these stocks are still paying that or above and have some growth potential, again, with the sell-off in these stocks, the yield has only gotten better. And I really do feel like these are going to be the coiled springs that end up bouncing back, and you're going to be happy to have these stocks in your portfolio, 12 months from now. And so, the ones clearly to focus on are, consumer staples. When you think about just the big names that are in there, the PepsiCos, the Clorox, all of these, food stocks are the food stocks are like the new retail stocks. I mean, they can't do anything right now, and it's just they're getting pummeled, left and right on earnings. And, the MLPs are suffering significantly, and I think there's some significant value there. Real estate, I mean, at some point, this sector is going to come back. It's if you look at how they cycle, historically, this is the time you're going to want to buy into these stocks, right now. And so, same with utilities. As soon as those interest rate fears are gone, people are going to be back into these, higher yielding stocks. And so those are the 4 sectors that I would, focus your energy on right now as you're putting new money to work. It's not a back the truck up scenario, but this is the place where you're going to find truly good stocks at good prices. And that's kind of the core of what our strategy is at the end of the day. Don't be afraid to put some money to work in some of these other cyclical sectors, because look, those are going to drive the market higher. You're going to want to be in those sectors. Obviously, make sure you're diversified by sector across the board, but definitely focus your energy on these value sectors, because I think those are the ones that have significant upside over the next 6 to 12 months, and you're going to be happy that you've got those high yielding stocks in your portfolio, and these are going to be good prices that you're going to look back on and really appreciate the fact that you got in them. So that's what I have for today. Again, the heat map is key to look at. Just following what's going on between the sector rotations, following those cyclical sectors and definitely those interest rates to kind of figure out when is there going to be a bottom here. But, we're never going to be able to time the bottom. And I think that these sectors have suffered quite a bit. And, I think now it could be the time to definitely start mining, definitely create your list in all of these sectors. Make sure that you've got, stocks that you want to buy in all these and start nibbling. Don't buy it all at once. Maybe buy 25%, 50% of what you might want a full position size to be. And, go ahead and invest at these levels. And if it trades lower, put a little bit more to work. But I think these are the sectors you want to focus on. So that's all I have for this week. Take care, everyone, and have a great week. I think we all know that the stock market can be a scary place, especially if you're trying to go at it alone. But you don't have to do it. You don't have to be there alone. At the Dividend Investors Club, it's community investors. We're working together to grow and preserve our wealth. So if you like this video, please check us out at dividendinvestorsclub.com. Consider joining the club and joining us. And definitely subscribe to our YouTube channel by clicking the subscribe button below this video. Take care.